All right, morning everyone. Sorry for the technical difficulty. I think I'll just get started. So welcome to our market outlook for 2022, entitled Late Cycle Dynamics. Just to introduce myself, my name is Christopher Kok. I'm the head of equities at Kenanga, and we have a team of about, I think, 14 people in the equities team at Kenanga. I think for those of you who follow us for a while, you all would know. So yeah, I think without delay, let's take it away. I think for today, I think I'll give you a very brief overview on what's happening in global markets, as well as Malaysia, and then a bit on the our funds. Of course, I think all of you might be aware, I think this week has been quite bad week for markets, and I'll touch a bit on that towards the end. Okay, global market review. Let's start with what happened last year in 2021. So I think last year, the performance has been actually diverged quite a fair bit. We saw actually developed markets like the US, Europe actually outperforming quite significantly, whereas China actually underperformed quite badly. So if we see the range performance, we see that I think between Taiwan and India and Europe, they're up more than 20%. I think if you look at the MSCI, China was down more than 20%. So I think most China funds did fairly poorly last year. As for the KLCI, I think we were slightly negative, around the range of 3 to 4%. Okay, I think I'll talk about going straight into the global cycle. So I think with regards to the global cycle, I think I'll go into the US, Europe, and then China. Okay, for the US, I think it fits into the title of our presentation, which is they're moving to late cycle. So after the coronavirus crisis, the US bounced back very strongly. I think they bounced back close to 5.6% in 2021. This is due to the vaccination, which actually led to the reopening, and also the record fiscal and monetary stimulus, which actually contributed to a strong economy. So in 2022, I think growth was slow to about 3.9%, but the momentum is still strong in the first half. So factors supporting growth include the labor market. I think we saw unemployment come down to a very low level. I think the economy is rebounding strongly because the amount of money the government pumped in the last 2 years. The inventory and capex upcycle is still an uptrend. So a lot of companies that we study and the companies that we analyze actually increase spending in terms of business upgrades this year. Whereas I think towards the middle of this year, we'll see factors detracting, which include a lower amount of fiscal support. So after a record budget stimulus in 2020 and 2021, we'll see that declining again, and also rising inflation. I think the key point to note here is that I think the US Federal Reserve is turning hawkish. So I think in December, we saw actually the CPI inflation at a decade high level of 7%. And actually this triggered lots of actually, increased pace of tightening and interest rate hikes. So I think the market is expecting about 3 to 4 hikes. If you look at the probability here on Bloomberg. So market is expecting about 3 to 4 hikes. Of course, whether they can actually do this is still yet to be seen, depending on how the economy pans out. But I think more importantly, they have announced that they have an end to its QE program. So in the last 2 years, the Fed has been buying 50 to 100 billion in terms of assets every month. Right now, they announced that they're going to stop in March. Actually, they might even stop next week in January. And they're also guiding for potentially, a decrease in the balance sheet, which would result in them withdrawing liquidity from the markets instead. EU. I think EU is maybe a quarter behind the US. I think its growth is expected to catch up to the USA with a fastest expansion of 6% in the first quarter. However, Europe is a big importer of energy, and then the rising oil and gas prices could be a slight drag on growth. But I think overall what we see is that I think the European Union is just slightly behind the US in terms of recovery, and I think we'll see another strong recovery in the first quarter as well. So I think for the full year, I think Europe is still looking at about 3 to 4% in terms of GDP growth. In terms of the liquidity, I think the ECB, the European Central Bank, has been following the footsteps of the US in terms of pumping money into the economy. So they actually announced last year the EU 1.85 trillion program. This will end in actually March this year. But then again, they will actually continue on with their other program, which is the asset purchase program. So actually the key takeaway is that the ECB is actually more, more supportive compared to the US because they still have this asset purchase program and they will still be pumping in money into the economy at a rate of 40, but then decreasing to about 20 towards the end of the year. So inflation is also picking up, but I think ECB, their view is that inflation is a bit more transitory, so they haven't guided for any rate increases yet. So in terms of monetary policy, Europe is definitely much easier than the US. Okay, so moving on to China. So you notice that whenever we cover certain regions, we talk a bit about the fundamentals in terms of GDP growth, and then we talk about the monetary policy because we believe that these two are the two main factors that affect markets. Number one, the fundamentals. I think number two, liquidity and monetary policy. So for China, I think last year was a bad year, as you all know. There's been a very sharp deceleration. So don't forget that China was the first out of the COVID crisis, and therefore they were actually the first to slow down as well. But not just that, actually the government has been taking this opportunity to tighten various sectors due to their desire to have structural reform. So actually they want to actually engineer a more equal economy. So actually last year the big theme was actually equality for all, common prosperity and so on. So actually they focus a lot on breaking up monopolies in various sectors. They wanted to cool down the property sector by tightening the loans. And they also want to reduce pollution by decarbonization. So we saw a lot of measures that were actually impacted listed companies. So that's why the market declined last year. I think this year growth will actually forecasted at 5%. But if the government doesn't loosen policy a bit more, it could drop a bit below 5%. Right. So property sector last year was also a drag. I'm sure we all heard about the Evergrande property crisis. So this actually impacted a lot of other subsectors as well. So we see that, I think here you can see property sales have been coming off. But I think the good news for China is that, we are towards the end of the slowdown. And in terms of the GDP, if you look at the GDP year-on-year growth basis, it actually picks up again from the second quarter of 2022, 4.2 to 4.7 to 5.7. So I think what's interesting to note is that China is moving in the opposite direction of the US, whereas US is entering a late cycle. The growth is starting to slow a bit. The Federal Reserve is tightening policy and hiking interest rates. China is going the opposite direction. China is, growth has been slowing and now starting to pick up a little bit. You see the Chinese government starting to ease policy and growth expected to rebound this year. So I think in terms of monetary policy, there's been some easing at the margin. So the PBOC has been cutting the reserve requirement ratio. This amount of money the banks need to keep a reserve and not lend out. So by cutting this, the banks have more money to lend out. So basically, they've cut it by 50 bips in December. And I think earlier this year, we saw, China has many different interest rates. So we saw actually some adjustment downwards in a few of these key rates. One of them is the loan prime rate. The other term is the medium-term lending facility. So I think that was in the news the last 2 weeks. So I think the overall takeaway is that the Chinese wants to reduce the interest rates and actually put more money into the economy, which should help a little bit to stabilize things. So what is the takeaway? I think the growth outlook was strong across developed economies, US and Europe, but the rate of change is slowing. So after a very strong rebound in 2021, we think US will start to slow down. But I think China is in the opposite case. China will start to pick up, in fact. And this is actually an important factor of having a diversified portfolio, which I'll go into later again. So we expect emerging markets to actually pick up. I think we saw that a lot of these emerging markets like Asia, I think last year was still struggling with COVID, battling with lockdowns. Which is why we didn't rebound as strongly as the US. I think this year, hopefully there's no more lockdowns, so we start to see a lot of these Asian countries recover again. So in terms of monetary policy, I think they're being tightened. So US Fed will be the first mover, although the number of hikes is still up for debate. So I think equities, could see high volatility. We saw US market quite volatile this week. Although the fundamentals in terms of growth is still supportive, but when monetary policy starts to tighten, we might see higher swings both up and down. In terms of key risks, I think key risk is still inflation, which will prompt the Fed to be continuously tight. And I think the second one, hard landing in China, for now, I think the government seems to recognize that we need to stimulate the economy. But, if for whatever reason, they backtrack and they did not stimulate enough, then I think China's growth could disappoint. Right. So I think to summarize, we still prefer emerging markets this year. I think if you read some of our outlooks that we've been publishing, we've been saying that we are overweight Asia in terms of China and ASEAN this year versus developed markets. Okay, going to Malaysia. For Malaysia, I'll spend a bit more time since it's our key market and also our home ground. For Malaysia, key trends to talk about is I think this year will be a year of economic recovery. Bank Negara should stay accommodative throughout at least the first half. EPF contribution flows to turn positive, and we're starting from a very low foreign shareholding base. And as for risk, I think the risk is the COVID is still a risk on the horizon. Hopefully there will not be any more lockdowns. Number two is the rise in taxation. We saw Cukai Makmur being implemented, which actually is going to impact the profits of big public listed companies. So if there's any more taxes, I think that could also damage confidence a bit. And of course, number three, monetary tightening in the US, and number four is a possibility of a general election this year. Okay, so moving on to theme number one, year of recovery. So last year we saw actually growth quite anemic at about 3 to 4%. But this year, I think the expectations that you'll bounce to about 5 to 6%, simply because of the reopening in the economy. And given our high vaccination rate, we'll probably see this reopening progress. And I think as of early of this year, I think it's close to 79% of the population was fully vaccinated already. And I think about 20% has received booster shots. So I think this argues in favor of a continued reopening. Supporting the growth in GDP will be consumer spending. So we think that there is still a lot of pent-up spending in consumer. I mean, if you just go out to malls, I think you can see malls being busy as ever as well. So we think retail sales will actually recover this year. And over the last 2 years, there's been a fair amount of savings being built up in the consumer's balance sheet as well. So this should actually help consumption. And I think the key sector to benefit from this is banks. So I think banks are normally a beneficiary when the economy starts to recover and interest rates start to move up, so that they can actually have better net interest margins. Asset quality is stabilizing, and the loans under repayment assistance is expected to stabilize in the back of economic recovery. So we think that loans can grow about 4 to 5% this year, and that will be positive for the banks, which are trading, still fairly cheaply compared to the last 5-year mean in terms of price to book, which is the key valuation metric we use for banks. Moving on to point number two, I think Bank Negara to stay accommodative in the first half. So I think Bank Negara will likely follow the US Fed. The expectation is that there could be 1 or 2 rate hikes this year for Bank Negara, probably by middle of the year, towards the second half. But I think in the recent statement, they have mentioned that they are more concerned on the growth outlook. So I think that there's risk to both global and domestic economies. And we are, for Malaysia, I think we're still very early in the recovery. So it is not wise to shock the economy with too many rate hikes at the beginning stage. Additionally, the CPI is forecast at 2% for 2022. Yeah, I know 2% seems low if you look at the price of goods and services nowadays. But this is what they're using, and based on this, it doesn't push for many rate hikes at the moment. Number three is that EPF withdrawal schemes are over. Why is this a good thing? Because I think last year there have been a lot of withdrawals by the EPF. About 100 billion was withdrawn from EPF. And as you know, the EPF is a big investor, both in the local equity and bond market. And when they are hit with withdrawals, they would have to actually sell or maybe even reduce the investments in the local market. So I think that has been contributing to the weakness in domestic markets as well. I think this year, without the withdrawals, EPF will likely reinvest its inflows into the domestic market and actually continue to be a factor supporting the market as it has in the years past. Theme number four is low foreign shareholding. I suppose this, you can look at it both for the glass half full, half empty kind of view. Foreign shareholding is at an all-time low right now at about 20%. This was, even lower, or actually close to the 2009 lows. So I think foreign selling has reached a peak already. We saw the actually net outflow start to moderate towards November and December. 2021 net outflow was about 3 billion compared to 2020's outflow of about 24 billion. So I think if money does come back to emerging markets, I think Malaysia could stand to be a beneficiary as well. So in terms of the risk, I think quite obvious is political risk. Although there's been an MOU with the opposition, the MOU would actually, I think, expire in July. So, once the MOU expires, there could be, talks of election or potentially one being triggered. Yeah. In terms of the ringgit, I think here no strong factor either for or against. I think ringgit, we probably think ringgit will trade range bound. Current account is still healthy at about 3.5% of GNI. So the current account actually supports the currency. I think that the ringgit will be driven more by external factors such as the movement in the US dollar. What is our strategy given all of this? I think we continue to adopt a barbell investment strategy. With one side focus on the recovery themes and the other focus on the growth stocks. So we continue to like the growth stocks because we think that the structural demand trend is still intact. I think the EV theme is still in its early days. In terms of EV penetration globally, we're still at a low rate, and I think the EV will continue to grow at 30 to 40% CAGR over the next 10 years. In China, EVs is already forecasted to reach about 12% of total vehicle sales. So we think that this demand for semiconductors, for EVs, for AI, for the Internet of Things will continue to drive a lot of these growth stocks and will continue to do so this year. In terms of recovery theme, as I mentioned, I think we like financials, the banks. We will be a key play for the domestic recovery this year. In terms of consumption, the consumer should also rebound strongly this year. We like consumer discretionary plays. And in terms of construction and property, I think it's more of a situational trading play. Construction, no doubt, will be a beneficiary if there's more jobs being awarded, but I think these are more tactical in nature. So not a sector-wide, but maybe just one or two names for the portfolio. Okay, I think I'll talk a bit about key fund performance before talking a bit about recent events. So I think key fund performance last year we saw I think fairly decent performance, mid-single digit to the double-digit performance for some of the funds. Of course, I think the standout was I think Kenanga growth did about 14%. And just to comment a bit, I think Asia was down last year due to our higher exposure in China. But then again, I think this year China is recovering, so this fund could actually be an outperformer this year. But as you all know, that the performance over 3, 5, and 10 years has been respectable, and I think that this is an indication that I think unit trust is a long-term investment, and we advise investors to hold over the longer term. So just a bit before I end this talk and go into Q&A, just a bit about recent events in the market. I think let me just move up to my earlier slides. Yeah, so I think key markets have actually declined quite heavily this week over concerns that the US Fed is withdrawing liquidity. I think that is a valid fear. Although markets are what we call reflective. In the case that the more the market declines, the more the Fed will actually potentially back off from actually rising interest rates. And actually, the rate hike is also dependent upon the pace of the economy. So although the market right now expects about 3 to 4 hikes in total, but it of course depends on the pace of the US GDP growth. So if the US GDP growth does slow a bit in the second quarter, probably they might need to actually reduce the number of rate hikes. So I think it's still yet to be seen. Although the sell-off has been concentrated in a lot of the very high growth names, a lot of the certain companies with strong fundamentals and strong earnings growth has been actually sold off together with everything else. So I think in this period of a broad sell down, I think there's always opportunity. There's always cases where the companies are still strong, but they get sold off together with everything else. So I think that's where we're looking at certain stocks and certain opportunities. And of course, moving on to China. This year, we think that China will outperform. So I think in your portfolio of unit trusts, I think it would be wise to be diversified as well. So if you look at our fund, our key funds that we list here, within this list, we have the Malaysia all cap fund like Kenanga Growth. We have a blue chip fund for large caps. We have small caps like Growth Opportunities and Shara Growth Opportunities. And then we have ASEAN, Asia, and Global as well. So I think, if you have a diversified portfolio, certain things will do well and certain things will do badly in different times. So, those could actually offset each other. So we recommend, investors to have a diversified portfolio across, both countries, types of funds, as well as between equities and bonds. Okay, so I think that concludes my presentation for today. And I'll go into Q&A.
All right, thank you so much, Mr. Christopher, for your sharings today. Okay, we will moving on. We are now going for Q&A session. Okay, then question number 1 we have here. Would you know how much and would the great resignation impact prospect of the US market, and it's a concern we have to look at?
Sorry,
the great resignation impact prospect of the US market.
Yeah. So actually, there's been a lot of news about what they call the Great Resignation, as you pointed out. So basically, a lot of people in the US are actually, there's been a lot of turnover in terms of labor force movements. So a record number of people have switched jobs, they have switched professions. I think as a result of this crisis as well, a lot of people have started to reevaluate things and decide what's important. So I think it's a trend that we're seeing globally. But actually what we're seeing is that, there's been a rotation in terms of, people trying new jobs and trying new sectors. But actually in terms of employment overall has been increasing. So, more and more people are, regaining their jobs that was lost previously. So the unemployment rate has been coming down. So I think it's been trending to, 3.9% in the latest data. So I think overall, despite, people moving around, the overall employment trend is still positive. And I think this is more of just, people looking for new jobs and not necessarily they being unable to find jobs or actually leaving the workforce entirely. So I think overall it's still supportive for the US economy.
All right. And then for the second questions, okay, so we see a recent sell-down on the tech sector in Malaysia. So is it a very good opportunity for Kenanga Fund that has high exposure in the tech sector in Malaysia?
Yeah, so I think as I mentioned, our strategy is, we maintain a barbell strategy. So on one hand, we still like the growth names. We believe that the tech sector still offers good earnings growth. I think despite the sell down, we've been talking to these companies, talking to management. We've been, redoing our analysis again. And, we still see that these companies can grow earnings. I think there's nothing wrong fundamentally with the companies. In terms of globally as well, I think, when we look at some of the semiconductor supply and demand situation, I think it's still expected to grow double-digit this year due to the structural trends, like I think the increasing number of EVs that will be sold, the increasing use of AI by companies worldwide. So we think that the earnings growth is still intact, although the sell down might be driven by withdrawal in liquidity. Especially, I think the sell down has been mirroring the sell down in the Nasdaq in the US. So we do think it is a good opportunity for certain of these companies that have still solid growth. But of course, we counterbalance our portfolio with other sectors like financials and also consumer. So yes, I would say that it is a good opportunity for those companies that are still solid earnings growth, and we're looking closely at it.
Okay, thank you so much. And then for the second questions, the third question, sorry, we do see that Malaysia is having, okay, in terms of the consumer spending, right? So since we see a lot of ETF withdrawals which happens recently, and then EPF being as one of the major contributors to the Malaysia stock market, will there be any long-term impact to the Malaysia growth?
Yeah. So I think on EPF, I've touched on it briefly. Last year was the biggest year of withdrawals, but I think this withdrawal is more of a temporary phenomenon. I think it's more of a special situation where last year, we were impacted by COVID very badly. But I think this year, the withdrawal schemes have come to an end. So I think this year EPF would, return to the market and begin adding back their equity exposures. So we do not think that this will be a long-term negative for the economy. I think EPF is, of course, a major shareholder, but I think, we also see a broadening shareholding base between local institutions and retailers as well. Yeah.
Okay, and then moving on to the next. Do you see small cap funds performing better than in the near term compared to the big cap counterparts, which are affected by the Cukai Makmur in Malaysia?
Yeah, so I think in terms of small cap, large cap, I think this year so far, I mean, it's not the end of January yet, but like this year, small cap funds are hit harder because of the sell down in the tech sector. Yeah, like I said, I think overall the tech sector still has strong fundamentals, but on a year basis, of course, it's hard to predict whether large cap or small cap outperform. I think in the last few years, small cap has did very well. So I think this year probably large cap has a higher than average chance. But in terms of investment, everything is about probability. It's hard to say for certain which one will outperform. So we still recommend a diversified portfolio. So I think your small cap funds are probably, if you have a football analogy, is more like your strikers. They're more aggressive. Of course, they can be more volatile as well. So for those who buy small cap, we should be aware, and also have some large cap like growth or blue chip in your fund. That's a bit more of your core holding of your portfolio, and then you also want to add in some regional. So I think we continue to recommend a diversified portfolio for investors, right?
All right, moving on. The US market do very well last year, and what's your advice to the investor over the US market this year?
So actually, I think US market has had 2 years of tremendous performance. I think Nasdaq has been up over 20% the last 2 years. So naturally, I think when things have been up so much, it's only natural for it to have a short maybe pullback. And in terms of growth and monetary policy, we see growth in the US starting to slow a little bit. Still at a decent pace, but no longer as strong as last year. And in terms of monetary policy, there's been a slight tightening by the US Fed. So actually, we do think that this year, actually Asia and emerging markets should outperform US. Now, whether or not US will end the year positive or negative, I think there's still up for debate. I think we don't really make market forecasts that way. But in terms of which region we prefer, we do actually say we prefer Asia this year over the United States. Yeah.
Okay. There's also a questions about the funds. Just a moment, yeah. Okay, could you just quickly explain on the hurdles rate that you mentioned earlier? Yeah, a lot of this in the table here, there's a hurdle rate. So a lot of attendees are asking what that means.
Sure. I think the hurdle rate just means the benchmark for that particular fund. So I think each fund has a different hurdle rate according to the mandate of the fund. So like I say, Kenanga Growth, the benchmark will be KLCI. So KLCI last year was minus 3.67. So that's the benchmark. For blue chip, I think the benchmark is the FPM 100. FPM 100 was minus 4.23% last year. And Sharia was minus 6 and so on. I think these funds are absolute return funds. That's why the hurdle rate is actually just a flat 8%. But for absolute return funds, normally the hurdle rate we tell people is that this fund is expected to achieve about 8% per year on average over a 3 to 5 year period now. Right. And lastly, we also launched our 2 global funds, which is the Global Growth Fund and the Global Islamic. So this one you can consider as well. Although probably the outlook for US might not be as great, but we are actually positioning this fund more towards Europe and also increasing the Asia allocation for this global fund as well. Yeah.
Okay, so the time is almost up. We will take one more last questions. All right. So may we know what's the difference between Kenanga Growth Series 1 and Series 2 versus growth opportunity, opportunity that contributes to a difference in performance?
Yeah, so I think the way to think about it is Kenanga Growth Fund is mainly Malaysia. I would say more than 90% in Malaysia, and it's a Malaysia all cap, meaning a mixture of both large and small cap. So, again, the football analogy, this is more like a midfielder in your team. Blue chip, obviously just a large cap, so I would say it's a bit more defensive. Maybe it will not go up so much when market is hot, but maybe when market is down, probably it won't go down as much as well. So that's blue chip for you. And Sharia Growth is just the Sharia version of, let's say, Kenanga Growth. Now, for growth opportunities and Sharia growth opportunities, I think for us, when we use the word growth opportunities, it's actually meant to reflect small cap funds. So these two are actually focused on a small cap. So, it's more aggressive fund. In up markets, it will outperform a lot, but probably, it could be more volatile in down markets as well. And then we move on to this two, which is the Malaysia Inc. and Kenanga Growth Series 2. So these are diversified funds, meaning that they have some in Malaysia and some overseas. So it tries to give you a balance of, what the best of Malaysia has to offer, and also a bit of the regional funds. So this is more like a mixed fund, like a midfielder, I would say as well. So I think and then the rest are more self-explanatory. ASEAN is ASEAN, and it's Asia Pacific, and global, both the conventional Islamic. So that's our funds that we have.
All right, thank you so much, Mr. Christopher, for joining us today, and thank you so much for insightful sharing.